Why being poor is expensive. Everyone thinks being poor means you spend less money, but in many cases, the opposite happens. When you don't have money, you pay more for food, you pay more for loans, you pay more for housing, you pay more for transportation. Sometimes you even pay more for the exact same product, which sounds ridiculous, but it happens everywhere. This is something economists sometimes call the poverty premium. It means the less money you have, the more expensive life can become. And it's not because poor people are bad with money. It's because the system quietly charges extra for people who can't afford better options. Today, we're breaking down how this works, why being poor often costs more, and why escaping that cycle is harder than people think. Let's start with a simple example. There's a famous economic idea often called the boots theory. The idea is simple. Imagine two people. One person has $200, the other has $20. Both need boots for work. The $200 person buys high-quality boots. They last 5 years. The $20 person buys cheap boots. They fall apart in 6 months. So the $20 person buys another pair, then another, then another. After a few years, the person with less money has actually spent more. Not because they wanted cheap boots, but because cheap boots were the only option they could afford at the time. This happens constantly in real life. Cheap products often break faster. Cheap shoes wear out. Cheap headphones die. Cheap kitchen tools snap. Cheap furniture wobbles after a year. If you can afford durable things once, you usually save money long term. But if you can only afford the cheapest option each time, you end up replacing it again and again and again. This is one way poverty becomes expensive. But that's just the beginning. Bulk is cheaper. Walk into any supermarket, look at the prices. The large package is usually cheaper per unit. Family-size cereal, bulk rice, big bottles of detergent. Warehouse stores work the same way. Buying more at once often lowers the price, but there's a catch. You need cash up front. If you only have $10 for groceries today, you can't buy the $25 bulk pack that saves money. You buy smaller packages, which cost more per serving. Over time, that adds up. So the person with more money spends less per meal, and the person with less money pays more per bite. The late fee machine. Now let's talk about late fees. Banks charge them, credit cards charge them, utility companies charge them, landlords charge them, phone plans charge them. If you miss a payment, you pay extra, which makes the next payment harder, which increases the chance you miss another payment. This creates a snowball effect. Late fee, interest, another late fee, more interest. A small financial problem slowly becomes a bigger one, and most late fees hit people who are already short on money. Expensive credit. If you have excellent credit, banks offer low interest rates. If your credit is weak, the rates jump, sometimes dramatically. Credit cards, car loans, personal loans. In many cases, the people who need loans the most are the ones paying the highest interest because lenders see them as higher risk. From a business perspective, that makes sense. From a life perspective, it means borrowing money becomes much more expensive. Payday loans. This is where things get extreme. Some short-term loans charge very high fees, often marketed as quick cash for emergencies. The idea sounds simple. Borrow a small amount, pay it back after your next paycheck. But the fees can stack up quickly if the loan rolls over or isn't repaid on time. Many financial experts warn that repeated borrowing like this can become very costly, which means a small emergency can turn into a much bigger financial problem. Transportation costs. Imagine two workers. One owns a reliable car, the other doesn't. The person without a car might need ride-hailing services, taxis, public transportation transfers, long commutes. Those costs add up. Sometimes unreliable transportation can even affect job opportunities. If it's harder to reach work, your options shrink, so transportation can quietly become another poverty expense. Food deserts. Some neighborhoods have fewer grocery stores, sometimes called food deserts. This means residents may rely more on convenience stores or small shops. Those stores often carry fewer fresh foods, and prices can be higher than large supermarkets. So even basic groceries may cost more depending on location, which means two families buying the same food can pay very different prices. Banking barriers. Some people don't have access to traditional bank accounts. Without a bank account, everyday financial tasks become harder. Cashing a paycheck might involve a check cashing service. Sending money might involve a money transfer service. Paying bills might involve prepaid cards. Many of these services charge small fees. Individually, they look tiny, but repeated every week, they add up. Time is money. Here's something people forget. Being poor often costs time, too. Time spent comparing prices, time spent traveling to cheaper stores, time spent fixing broken things, time spent dealing with billing problems, time spent waiting in lines. People with more money often buy back their time. They order delivery, they hire help, they pay for convenience. Time saved can then be used for work, learning, or rest. Time lost can create stress, and stress can make financial decisions harder. Stress and decisions. Financial stress affects decision-making. Research in psychology suggests that constant financial pressure can narrow focus towards immediate problems. When you're worried about paying rent this week, long-term planning becomes harder, not because someone lacks intelligence, but because the brain is prioritizing survival. Short-term survival often beats long-term optimization, which can reinforce the cycle. The cycle. When you add everything together, higher product replacement, higher borrowing costs, more late fees, higher grocery prices, extra service fees, transportation costs, lost time, it creates a pattern, small disadvantages stacking on top of each other. One problem makes the next one slightly worse. That's the poverty premium. The important point. None of this means people are doomed. Many people do escape poverty. Education, career growth, support systems, financial planning, opportunities, all can help improve financial stability. But understanding the system matters because it explains something important. Being poor isn't always expensive because of bad choices. Sometimes it's expensive because the system charges extra for people who can't afford better options. Rapid recap. Being poor doesn't always mean spending less. Cheap products often break faster and cost more over time. Buying in bulk is cheaper but requires more upfront cash. Late fees and penalties can snowball. People with weaker credit often pay higher interest rates. Some short-term loans can become very expensive. Transportation limitations add extra costs. Some neighborhoods have higher food prices. Financial service fees can accumulate. Time pressure and stress make financial planning harder. These factors together create the poverty premium. Final thought. Money does something interesting. It doesn't just buy things, it buys better options. Better options often mean lower long-term costs, fewer fees, less stress, more time, which is why escaping poverty is not just about earning more, it's about breaking the expensive traps that come with having less. If you made it this far, nice. Drop a comment with something that secretly costs way more than people realize. Like the video, subscribe for more explainers, and remember, sometimes the most expensive thing in the world is not having money in the first place.